can. The second number is 59 and a half. That's the age when you can begin to withdraw funds from a seasoned Roth with no restrictions. As with a traditional IRA, other ways to avoid penalties are death, disability, and being a first-time home buyer. The exemption for withdrawing funds to buy your first home is another powerful incentive to start your IRA immediately. Suppose your son Daniel's first real job is herding shopping carts in the parking lot of the local grocery store at the age of 15. He might not make much, but for starting an IRA, that's fine. Have him open an IRA account, no matter how small. He'll have access to the full account value up to the $10,000 lifetime home buyer limit if he decides to buy a house. It probably won't be a large sum if he taps the account soon, but by the time he's, say, 30, that won't be the case. You'll get hit with taxes on your earnings and a 10% penalty if you don't meet those withdrawal criteria. But notice I said earnings. Yes, you'll get hit pretty hard if you withdraw earnings, but you can remove contributions from your Roth IRA without penalty. That's another big loophole in the withdrawal restrictions. Roth accounts can be great estate planning tools. If you die before you withdraw all of your Roth funds, then your heirs can withdraw the money over their expected lifetimes. They don't have to take it all immediately if they don't want to do that. Whatever assets your heirs leave in the account continue to grow tax-free. You can even tap funds temporarily if you have a short-term cash need. You can withdraw funds from your Roth for any reason and repay those withdrawn funds within 60 days with no penalty. Repaying the contribution lets you continue to have a bigger pile of cash working for you tax-free. You don't need to rebuild your Roth a little at a time over the years. Before 2010, if you made more than the income limits, then you couldn't deduct your contribution to your traditional IRA, and you couldn't contribute to a Roth at all. You were just out of luck. Since 2010, though, you can fund your Roth through the back door in just 2 steps. In the first step, you contribute funds to a traditional IRA. Because of the income limits, you can't deduct your contribution. But then comes the second step. You just convert that traditional IRA into a Roth IRA and pay the taxes on the converted value because, as we saw earlier, Roth IRAs must be funded with after-tax dollars. Voila! You made a perfectly legal Roth contribution despite being over the contribution limit. Your broker or mutual fund company should be able to handle all of this for you with, at most, a couple of phone calls. Being able to convert from one type of IRA to another is especially valuable to people whose income fluctuates. Suppose you're not sure whether you qualify for a fully deductible traditional IRA. Maybe you want to fund a traditional IRA if you can deduct the contribution, but if not, then you want to fund a Roth IRA. What can you do in this case? The best thing to do is fund one or the other by the initial filing deadline, usually April 15th, and then revisit your decision no later than the end of the extended deadline, which is usually October 15th. That's because the IRS lets you recharacterize an IRA contribution. You can convert a traditional IRA contribution to a Roth contribution, or you can convert your Roth contribution to a traditional IRA contribution. You can also convert an existing traditional IRA to a Roth. You'll incur a tax liability if you do that, though. Say you have $40,000 in a traditional IRA. You can convert that to a Roth, but you'll have to add $40,000 to your taxable income that year. If you're in the 25% marginal tax bracket, then you'll have to come up with $10,000 more in taxes. Generally, you don't want to do that. If you're going to have to reduce your IRA contributions in the year of the conversion to cover that $10,000, then it's probably a bad idea to convert in the first place. Having $30,000 in a Roth is probably not as good as having $40,000 in a traditional IRA. The best